Most people spend their whole lives trying to earn money. Very few ever stop to ask a deeper question. What would it mean to own the things that produce money? And that's where a tiny misunderstanding creates a massive financial difference. Because a lot of people hear words like stocks and shares, and they assume it's all just Wall Street language, just technical jargon, just something for experts. But it's not. That difference can shape how you think about investing, risk, ownership, and ultimately your future. Because if you see the stock market as a casino, you'll probably stay away from it. But if you see it as a system of ownership, you may never look at money the same way again. And here's what makes this even more important. Every single day, millions of people wake up, go to work, trade their time for money, and then hand that money to people who already understand something they don't. It's not a secret society. It's not insider knowledge. It's a concept so simple it can be explained in a single sentence. But because no one taught it clearly, most people spend their entire lives on the wrong side of wealth. You were taught how to earn money, but you were never taught how to own what produces it. Today, we're going to change that. So by the end of this video, you'll understand stocks versus shares in the simplest way possible. You'll see how stocks actually work, and more importantly, you'll understand why this isn't just about vocabulary. It's about mindset, identity, and how you build wealth over time. No hype, no get-rich promises, just clarity. Welcome back to Financial Psychology. If you're serious about clarity, wealth building, and making smarter long-term decisions with money, you're in the right place. Today, we're breaking down one of the most basic but most misunderstood ideas in investing for beginners. What's the difference between a stock and a share? Now, on the surface, this can sound small, almost too small to matter. But it matters a lot more than most people realize. Because when people don't understand ownership, they often delay investing. They hesitate. They overcomplicate it. They assume they need to be rich first, or brilliant first, or perfectly informed first. And years go by. So in this video, I'm going to make this incredibly simple. We'll cover the definitions, we'll use real companies like Apple, Tesla, and Coca-Cola. We'll use a visual metaphor that makes the whole thing click. Then we'll go deeper into what really matters. How money is actually made, why people delay for years, why fear and confusion cost more than most bad decisions, and how understanding this one idea can support a more grounded path toward financial freedom. By the end of this video, you won't just know the terms, you'll see the entire system differently. Now, simple core explanation. Let's simplify this as much as possible. A stock usually refers to ownership in a company in a broad sense. A share is one individual unit of that ownership. So if someone says, "I own stock in Apple," they're saying they own part of Apple. If they say, "I own 15 shares of Apple," they're telling you how many units of Apple ownership they actually own. That's the basic difference. Think of stock as the category. Think of shares as the count. Here's the simplest version. Stock is the idea of ownership. Shares are the pieces of that ownership. So let's make it real. Apple is a public company. When people buy Apple stock, what they're really buying are shares of Apple. Tesla works the same way. Coca-Cola works the same way. If you own one share of Coca-Cola, you own a very small slice of Coca-Cola. Not a symbolic slice, a real one. Tiny, yes, but real. And that mental shift matters, because now the market stops being just numbers moving on a screen. It becomes partial ownership in real businesses. Businesses that sell products, hire people, generate revenue, try to make profits, expand into new markets, and sometimes struggle. That's why this matters so much in stock market basics. If you think you're just buying a ticker symbol, investing feels abstract. If you understand you're buying a piece of a business, investing becomes much more concrete.
Let's go one level deeper. Imagine a company is divided into millions or even billions of pieces. Each piece is a share. When you buy one, you own one piece. When you buy 10, you own 10 pieces. The value of those pieces can go up or down based on many things: how the business performs, how much profit it makes, what people believe its future looks like, how the economy is doing, interest rates, competition, fear, excitement, sometimes rational things, sometimes emotional things. That's why prices move. But the foundation stays the same. You are buying ownership. So when people search for how stocks work, the first answer shouldn't be charts. It should be this. Stocks are a way to own part of a company. Shares are the individual units you buy. That's it. Simple, but powerful. Because once that clicks, you stop thinking like a spectator and you start thinking like an owner. The visual metaphor. Now, let's use a metaphor that makes this instantly understandable. Imagine there's a local coffee shop in a growing neighborhood. It's well run, it has loyal customers, its sales are rising. The owner wants to expand to a second location but needs more capital to grow. So instead of borrowing all the money, the business is divided into 1,000 ownership pieces. Those pieces are offered to investors. Now, the coffee shop itself is the business. The stock represents ownership in that business, and each one of those 1,000 pieces is a share. If you buy 10 of those pieces, you own 10 shares. That means you own 1% of the coffee shop. Now, think about what that means. If the business grows, your ownership stake becomes more valuable. If profits are shared with owners, you may receive income. If the coffee shop expands from 1 location to 3 and becomes more successful over time, your small stake can grow with it. That is the heart of investing. Now let's make it even more mature. Picture an apartment building in a city like Chicago, Vancouver, Dallas, or Toronto. It has strong tenants, it produces rental income, and it may become more valuable over time as the area develops. Now, imagine that the building is divided into ownership units. Not everyone owns the whole building. Different people own pieces of it. One person owns 2%, another owns 5%, another owns less than 1%. That's what shares are, ownership pieces. And if the building generates income, owners may receive part of that income. If the building becomes more valuable, the value of those ownership pieces may rise. That is exactly why this concept matters. Because when you understand stocks and shares properly, you realize investing is not mainly about guessing, it's about participating. You are not just watching businesses grow, you are trying to own part of that growth. That's the click. That's the shift. That's why stocks versus shares explained properly can change how someone sees money forever.
Now, the story-driven explanation. Let's make this personal. Imagine 2 people. The first person is Christopher Lee, and the second person is Ashley Robinson. They're both 30, they both live normal, busy lives, they both work hard, they both want more freedom, they both say they want to build wealth, and they both feel, quietly, that they should probably start investing. But they respond very differently. Christopher tells himself he'll start later. He says he wants to understand everything first. He wants to know the perfect time, the safest company, the right headline, the right app, the right strategy. He keeps watching videos, reading comments, listening to opinions, and because he feels confused, he does what many intelligent people do when they feel overwhelmed. He delays. Ashley feels confused too. She doesn't know everything. She has doubts. She worries about making mistakes. She worries she's starting late. She worries the market could fall the moment she begins. But she learns one simple idea. Buying shares means buying small pieces of real businesses. That changes something for her. Suddenly, she's not thinking, I'm gambling. She's thinking, I'm learning ownership. So she starts small. Not recklessly, not dramatically, just intentionally. She buys a few shares in companies she recognizes. Maybe Apple, maybe Coca-Cola. Maybe she watches Tesla too, but studies it before making a bigger decision. She keeps the amounts manageable. She knows this is education with real money attached. Now let's pause here. This is where most people think the story becomes magical. It doesn't, because real investing is not a straight line. A few months later, the market drops, prices fall, her account goes red, the excitement disappears. And now the emotional test begins. Christopher sees the drop and feels validated. He says, "See, that's exactly why I stayed out." Ashley sees the drop and feels something much harder. Fear, regret, self-doubt. She wonders if she made a mistake. She checks her account too often. She feels the urge to stop.
This is where financial psychology matters, because the numbers are not the only thing moving. Your emotions are moving too. Christopher thinks he avoided risk, but there's another kind of risk he doesn't see. The risk of doing nothing for too long. The risk of staying a spectator while time passes. The risk of letting confusion become a permanent strategy. Ashley, on the other hand, has entered the arena, and that means she now feels volatility. But she also learns something deeper. Apple is still selling products. Coca-Cola is still selling drinks. Tesla is still operating as a real company. The screen is red, but the world has not ended. So she slows down. She keeps learning. She doesn't pretend risk isn't real. She doesn't blindly buy more just because someone online told her to. She studies what she owns. She thinks longer term. And over the next several years, something important happens. Not perfection, not guaranteed profits, not endless gains, just something more realistic. She develops the mindset of an owner. She stops reacting to every short-term move as if it defines her future. She understands that one bad month is not the full story. One correction is not the full story. One scary headline is not the full story. Christopher still wants certainty before starting.
Ashley has accepted a mature truth. You rarely get certainty first. You usually get clarity through participation. Years later, Christopher looks back and realizes something painful. He thought he was being cautious, but a lot of his caution was fear of wearing professional clothes. He thought he was protecting himself, but often he was protecting himself from discomfort, not from bad decisions. Ashley also looks back. She remembers the nerves, the doubt, the ugly market days, the temptation to quit. But she also sees something else. She owns things now. Not enough to retire, not enough to brag, but enough to understand the path. Enough to feel the difference between only earning income and slowly building ownership. And that emotional difference is huge, because once you understand ownership, you stop seeing investing as a luxury for rich people. You start seeing it as a framework for building a future. That is the real change, not just in your account, in your identity.
Fast forward to today, 2026. Ashley looks back at her first investments in 2016, just a few $100s in companies she understood and believed in, like Apple, Tesla, and Coca-Cola. She invested consistently, a small amount every month, and didn't panic during market drops. She focused on ownership, not short-term gains. Now, 10 years later, those small, consistent investments have grown to over $45,000, a real tangible result that demonstrates the power of patience, consistency, and long-term thinking. Ashley is thrilled, not just by the number, but by what it represents. She didn't rely on luck or trying to time the market. She built real ownership in real companies, steadily growing her wealth year after year. More importantly, Ashley's mindset has transformed. She no longer sees money as something she must chase or a tool for immediate gratification. She now thinks like an owner, understanding that wealth comes from participating in the growth of businesses over time. That psychological shift, seeing herself as a stakeholder, not just a worker, is what truly sets her on a path to financial freedom. Ashley now sees herself not just as someone earning a paycheck, but as a business owner in miniature, participating in the growth of major companies. That's the true power of investing. Starting small, thinking long-term, letting time and ownership work for you, and transforming your relationship with money in the process.
Now, how money is actually made. So, how does money actually get made when you invest in stocks and shares? There are three simple ideas to understand. First, there's capital appreciation. That just means the value of your shares rises over time. If you buy shares in a company at one price, and years later those shares are worth more, that increase is capital appreciation. Second, there are dividends. Some companies share part of their profits with shareholders. Coca-Cola is one of the examples many people hear about because mature companies sometimes pay dividends more consistently than high-growth companies.
Not every company pays dividends. Apple may return value in different ways. Tesla, for example, has often been thought of more as a growth company than an income company. The key idea is simple. Some businesses reward owners through cash distributions. Others focus more on reinvesting to grow. Third, there's your time horizon, and this is where many people get lost. A short-term mindset says, "What happens this week?" A long-term mindset asks, "What kind of business am I owning, and where could it be in 5, 10, or 20 years?" That doesn't mean you ignore risk. It means you stop expecting the market to behave like a vending machine. You put money in, you do not instantly receive certainty. That's why long-term investing matters so much. It gives real businesses time to grow, and it gives you time to think more clearly.
Now, the psychology layer. Let's talk about the real reason this topic is bigger than vocabulary. Most people do not delay investing because they are lazy. They delay because they are psychologically overloaded. They think, what if I'm too late? What if I start right before a crash? What if I pick the wrong company? What if I lose money and feel stupid? And beneath all of that is a quieter fear. What if everyone else understands something I don't? That fear creates paralysis, and paralysis is expensive. Then there's herd mentality. When prices are rising and everybody sounds confident, people want in. When prices are falling and everyone sounds scared, people want out. In other words, many people don't follow values, they follow emotion, and emotion is contagious. This is where the average mindset and the wealth mindset start to separate. The average mindset says, "I'll start when I feel completely ready." The wealth mindset says, "I may never feel completely ready, so I'll start carefully and keep learning." The average mindset asks, "What stock will make me money fast?" The wealth mindset asks, "What am I actually owning and why?" The average mindset treats the market like entertainment. The wealth mindset treats it like a long-term system of ownership. The average mindset is obsessed with timing. The wealth mindset is focused on understanding. And this is why the distinction between stocks and shares matters psychologically. Because once you understand that shares are ownership units, you stop seeing yourself as someone trying to beat the system. You start seeing yourself as someone learning to participate in it. That reduces confusion. It slows the urge to chase hype. It creates patience, and patience is rare, especially in a culture that wants everything immediately. The truth is, many people are not behind financially because they lack intelligence. They're behind because they've spent years standing at the edge of the pool, analyzing the water, instead of learning how to swim. The balanced truth. But let's stay grounded, because responsible investing content should tell the full truth. Stocks carry risk. Shares can lose value. A company can disappoint investors. A strong business can go through weak years. A popular stock can become overpriced. A market can fall sharply. And sometimes it can stay down longer than people expect. There are no guaranteed returns here. No promises, no shortcuts. No honest person can tell you that understanding stocks and shares automatically makes you wealthy. What it does do is give you a better foundation for decision-making. And that matters, because reckless investing is dangerous, but permanent confusion is dangerous too. So the goal is not blind optimism. The goal is informed participation, calm participation, long-term thinking, and an understanding that wealth building is usually slower, less exciting, and more psychological than social media makes it seem. This video is educational, not personal financial advice, and that distinction matters because your risk tolerance, timeline, income, debt level, and goals all matter too.
Practical action steps. So what should you actually do with this? Start simple, start small, and start with understanding. First, stop asking only, "What stock should I buy?" Start asking, "What does ownership mean?" That one question changes everything. Second, if you're new, don't pressure yourself to be impressive. You do not need to make a dramatic move.
Even buying a small amount and observing how you feel can teach you a lot. That matters for investing for beginners, because the first lesson is often emotional, not mathematical. Third, learn the business before you buy the shares. If it's Apple, ask yourself how the company makes money. If it's Tesla, ask what expectations are built into the stock price. If it's Coca-Cola, ask why investors may value a mature brand differently from a high-growth company. Fourth, think in terms of diversification. You do not need your entire future hanging on one company. Owning multiple businesses or using diversified funds can help reduce the damage if one idea goes wrong. Fifth, use the right account structure where possible. If you're in the United States, that may mean learning about accounts like a 401k, IRA, or Roth IRA. If you're in Canada, that may mean understanding a TFSA or RRSP. The details depend on your situation, but the principle is universal. Where you invest matters almost as much as what you invest in. Sixth, lengthen your timeline. The shorter your horizon, the more noise controls your emotions. The longer your horizon, the more business fundamentals can matter. Seventh, keep your expectations realistic. Some years will feel rewarding, some will feel frustrating, some will test your patience. That is normal. And finally, remember this: the goal is not to become someone who chases stocks. The goal is to become someone who understands ownership, risk, time, and behavior. That is the deeper path toward financial freedom. Now here's the perspective shift I want to leave you with. Most people are taught how to work for money. Very few are taught how to think like owners, and that changes everything. Because the real power of understanding stocks and shares is not that you learn a new definition. It's that you stop seeing money as something you only earn. You begin to see it as something you can deploy into productive assets. You begin to understand that a share is not just a number. It is a claim on a business. A small one, yes, but a real one. And over time, that mental model can quietly reshape your future. The goal isn't just to earn money, it's to own what produces it. Wealth usually isn't built by working harder alone. It's built by combining income with patience, by combining discipline with a longer view than most people are willing to take. And sometimes the first step into that world begins with a very simple realization. Stocks and shares are not just market terms. They are your introduction to ownership. So, let me ask you, when you think about your financial future, do you see yourself only as a worker or also as an owner? And what's been your biggest hesitation when it comes to investing? Confusion? Fear of losing money? Feeling like you're starting too late? Or just not knowing where to begin? Drop your thoughts in the comments. I read them all. And if this video helped you understand stock market basics, how stocks work, and the real difference in stocks versus shares explained simply, always stay tuned on this channel for more calm, clear, long-term content on money, behavior, and building wealth with intelligence instead of hype.
Thanks so much for spending your time with me today. I really appreciate it. If something in this video clicked for you, even just a small shift in perspective, go ahead and hit that like button. It's a simple way to support the channel. Feel free to share this video with friends or family who are also trying to better understand how money really works. And don't forget to subscribe to this channel, Financial Psychology, and turn on the notification bell so that you never miss insights that could shape your future. I'd love to hear your thoughts too, so drop your comments and questions below. Let's start a conversation. Take care of yourself, keep growing, and I wish you nothing but progress on your financial journey. See you in the next video.